change from Canada's banking regulator, that is OSFI, that clarified a 50% mortgage test that could reshape how banks treat your rental income. And if you're an investor or future homeowner, this video will show you exactly what it means for you with the numbers. Hello everyone, my name is Parth Soni. I'm a realtor based in Ontario. I help families and investors like you to get into real estate. Today, I will explain OSFI's updated approach to mortgages where rental income is used to qualify them, the 4.5 times loan to income that is usually called as LTI or LTV, however you want to do it, constraint for uninsured mortgages, and in what it means for you as an investor or as a home buyer with the numbers. And before we go further, let me quickly explain you who OSFI is. So OSFI is basically, the full form is Office of Superintendent of Financial Institutions. It's a Canada's national banking regulator. Now, they oversees banks, credit unions, mortgage lenders to make sure that the financial system stays stable and borrowers are not taking too much of a risk. Or so basically, when OSFI changes a rule, lenders across Canada follows it, and it directly affects how mortgages are get approved. So the very first thing, let's see what is change, and I will try to explain this in a very plain and simple language. Now, OSPI clarified two things back in November of 2025. The very first one was the 50% borrower income test. It is used to decide whether a mortgage is treated as income producing, that is a largely supported by a rental income or not, and that kind of stuff. And the second is a portfolio level limit that restricts how many new uninsured mortgages can exceed a loan to income multiplier. Right now, commonly is 4.5 times. Now, to explain in simple terms, if more than half of a borrower qualifying income or for the mortgage comes from the property, many banks will treat that loan as an investment type or income producing loan. And again, I will explain you with an example. And this could lead to applying stricter capital or underwriting treatment. Separately, banks are being told to cap the amount of very high LTI uninsured mortgages they originate at a portfolio level. Now let's understand why did Oscar did this, why these changes are going on, and why they clarify right now. So the Oscar's goal is financial system stability. Now, how high household debt and lot of income leverage mortgages increase systematic risk, and we have seen what happened in past couple of years. And this measures reduces the share of a very high leverage uninsured loans and make banks manage rental heavy loans, basically more conservative. This guidance item have been introduced incrementally over 2025 and 2024. So back in 2024 it started, some clarification made in 2025. Now let's see a very clear thing how investors are affected with this. Now, if you rely on rental income to qualify for mortgages, by the way, some investors do that, then lenders may now classify that loan as an income producing if more than 50% of qualifying income comes from the property. And income producing loans typically face stricter underwriting, higher capital cost to lenders, and therefore they do have a tighter lending in some cases, basically higher interest rate, large down payments are required, or sometimes your application might get rejected. OSPI also clarifies lenders should not let the same rental income be reused to qualify for multiple mortgages. Now, income used for one property can't be recycled to qualify for a new purchase, which many investors use this loophole, but this is something now in a place right now, so that's a really nice thing. And at portfolio level, banks now limit how many newly originated uninsured mortgages can exceed the LDI threshold, that is 4.5 times. Now that means fewer very high LTI loans get approved by traditional lenders, especially for buy and hold investor strategies that rely on aggressive leverage. Now, there could be a couple of impacts for investors. The very first one would be higher capital cost, less availability for aggressive portfolio growth, likely higher rates, or bigger down payment for properties that are rental income reliant. Now, let's understand how home buyers, including first time home buyers, will get affected. So, for homeowners who are salaried and buy with standard income, so basically you are getting the income from the job, the hit is smaller. It's not that much. For insured mortgages, where down payment is typically less than 20%, remains outside of this portfolio cap. So if you're someone who's paying less than 20%, you are not affected. But first-time homebuyer who need larger mortgage relative to income could face a tighter underwriting environment if bank tighten around high LTI loans. So that is what happening right now, especially for someone who's putting more than 20% down payment or higher. Like when I work with some clients, they put like 40-50% down payment, and yes, that does happen. They might face this new changes. And if you plan to use your rental income from an existing property to qualify for a newer mortgage, expect lenders to scrutinize how much of your qualified income really comes from rent, whether that income can be reused or not. So here are the two examples that I have come up with, so you get an idea. Basically, the numbers may not make sense in real life scenario, but just to give you an idea what these rules look like and how you can see over. So investor using rental income to buying property. So let's take an investment property. Let's say if you're an investor and your income is $40,000, again multiply it in the multiples, however you want to do it. And the rental income you are getting from the new property or the property that you are buying as an investment is $30,000. So total qualifying comes at $70,000 as of right now. Now, based on 50% test rule, here's how the formula applies: rental income divided by total qualified income. So in this case, 30,000 divided by 70,000, it comes to 42.9%. Again, that is less than 50%. So bank will treat as a normal traditional mortgage in this scenario. And loan in this one may not be classified as an income producing on 50% test alone. Now let's change the number and reverse the number. So if you see over here, I've changed the number. Investor income is 20,000, it's less, and the rental income is 40,000. By the way, many people, especially people are buying triplex, fourplexes, which are not under commercial as of right now, are using this. So those people will be get affected more in this scenario. So investor income $30,000, rental income $40,000, total again 70,000, all same, no change in that one. If we do the test, 50% test over here, it comes at 57.1%, and that is higher than 50%. So bank is likely to treat loan as an income producing, which means stricter treatment, possibly higher pricing or decline as well. Now let's talk about first time home buyer and 4.5 times the LTI. Now you're a first time home buyer with a gross annual income of $100,000. With the basic LTI guidelines, many lender reference that as 4.5 times your income for an uninsured portfolio rules. So theoretically, maximum mortgage would be $100,000 times 4.5, it's $450,000. And that is the mortgage, not the purchase price. Now, if the purchase price requires an uninsured mortgage above that number, bank will count it against their portfolio cap and may be less willing to approve. So make sure you reach out to your broker, you reach out to the mortgage agent or a bank and understand this. And also remember, like insured mortgages that is less than 20% down payment are treated way differently. And these rules are different than 20% or higher mortgages, which is like an uninsured mortgages. Now, here are some of the practical lender behavior that you may see when you go out and apply for a loan or a pre-approval and things like that. So, very first one in this one is that lender could ask you for a clear rent roll and lease documents. The second is that they can also refuse to let some rental income qualify for multiple purchases. They can also raise prices or require down payment on income producing loans, and they may also prioritize insured mortgages for borrowers with thin income relative to the price. Now, as an investor, as a buyer, what should you do next? The very first one, if I were in this position, I would do is talk to my broker who work with multiple lenders, and lender response will vary. And some non-bank or private lenders may offer different solutions as well for this one. Document rental very thoroughly, very properly, especially all the income producing documents, all the leases, T4s, T776S, and all those kind of documents. Basically, if you are a landlord, you will know about this. And if you're planning aggressive portfolio growth, expect higher cost and slower scale as of right now. What we have seen in last couple of years, people are scaling, getting multiple properties. That might not be the case as of right now. and banks and this kind of regulatory committee is enforcing more stricter rules to have those kind of peoples to have multiple portfolios. The bottom line in this one is that OFSI 50% income test and the LTI portfolio limit are meant to slow the riskiest, most leveraged lending in the history. Now, if you're an investor who relies primarily on rental income, this matters. And it will change how banks underwrite your bill. And if you're a home buyer, the effect is still more muted, but still it's worth knowing what is happening around the mortgage industry. And if you want, I can make a calculator for you exact situation. Drop a number below in the comment or reach out to me through an email and I'll walk. Thank you so much for watching. I will see you in the next video.